In this short video, I want to go over what is the difference between a $1 wide and a $2 wide vertical credit spread. How does it differ in your return and your risk and your win rate? Because it does change with each one of these things, even though you have the same overall idea for your trade. All right, let me walk you through this because this is a recent question that came up in my 10% Credit Spreads Inner Circle program. And so again, I kind of walked them through it, and I thought it'd be great to have a video for you guys as well. So let's go through this. Okay, so first off, what is a credit spread for those who don't know? Well, simply, just real quick, a credit spread is placing a bet on a stock. For instance, if let's say the stock is trading here, well, if the stock is trading here and it looks like it's going to head higher, you're going to place a bet where you think, okay, I think the stock is going to stay above this level within the next 2 weeks, and so that's your bet. As long as the stock stays above that level, no matter what it does, then you make money. That's essentially what a vertical credit spread is. You do that by combining two options. Anyways, let's walk through the difference between a $1 wide and a $2 wide. When you structure a credit spread, you have two different types of options orders, right? So let's say we're doing a put credit spread, which would have been this example, which means that you're placing a level below the current stock price, hoping for the stock price to, in general, move higher. So when you have that, what you're looking for is to set up a credit spread where you sell one level and then you buy the next level. Why is this? So you sell this one and you buy this one. Why is this? Well, because when you sell, you get a credit. When you sell something that's closest to the stock, you get a larger credit. Then you buy the one below it to define your risk. If you just sell an option, you have unlimited risk, so you buy it. So anyways, that would look like, for instance, let's say we're just making up numbers. Let's say this is, I think it's going to stay above the 400 level. So the first option I sell will be the 400 strike price option. So I'm going to sell the $400 put. And then for a $1 wide spread, which is what most spreads are, I'm going to then buy back the $3.99. So $3.99, just like that. This is a $1 wide spread. Why is it a $1 wide spread? Because again, the difference between 400 and $3.99, our two levels, is $1. And so again, that also defines our risk. So for instance, if we have a $1 wide, which is this, the 439, let's say we collect in credit, so let's just say CR for credit. Credit, we collect 15 cents. Okay, cool, 15 cents. So if this is the amount of money we stand to make, which is the credit, so if this trade stays above 400, then we make 15 cents. But how much do we stand to lose? So if I just say lose here, or loss, like that, then again, we have the $1 is our width. So that means $1 is the overall amount of risk that we have on the table. Why? Well, because if this thing expires worthless, meaning that the stock goes, in the money, which means that the stock goes below the 400 level, then guess what? This right here, this option gets executed. So I have to sell 100 shares at the $400 level. But then my $3.99 is going to protect me, so I'm going to buy back. So that means I'm risking $1 per share because there's a difference of $1. So since there's a difference of $1, I'm going to put 1. But then also when I put this trade on, I immediately get a 15-cent credit. So that's 15-cent credit. So this is my max risk. I put up $100, but I received 15 cents in credit, so that was credited to my account, which gives me a max loss of 0.85. So that means if this trade goes against me, I'm going to lose 85 cents. If this trade goes in my favor, I'm going to make 15 cents. So that's how it's structured for a $1 wide spread. So let's look at a $2 wide. How does this differ? Well, let's say a $2 wide right here. So we're going to start off with their same level. We still think it's going to stay above 400. So we're going to sell the 400 level. And now we're going to make it a $2 wide. So a $2 wide would have a bought strike price of $3.98. So instead of $3.99, we're going $3.98 because it's a $2 difference between here. Now, how does this change our credit and how does this change our loss? Well, in a credit aspect, it actually is a little different, and that's going to be what is important to be discussed here in this video. So credit, so you'd be like, okay, if it's $1 wide and I'm collecting 15 cents and it's $2 wide, how much credit do you think you should collect? Most people think it's 30 cents. That's actually not correct. If it's trading at 15 cents for a $1 wide, your credit on a $2 wide is going to be roughly around 25 cents. Why is this? Well, it's the law of diminishing returns, and I'll explain that here in a second, but it's roughly around 25 cents. Now, how does this affect our loss? Well, instead of 1 minus 15, we're going to be doing 2, because that's the width of our spread, minus the credit we collected, 25, like that, and that's going to give us a total risk of $1.75. Okay, so you're like, okay, yeah, Austin, $1 is way more than $1.75 is way more than 85 cents, but is that comparable? Well, let's look at the math real quick. Okay, so we need to look at what is our return on our risk. That is how we determine return with credit spreads. So what's our return for the $1 wide? Well, it's 15 cents divided by our risk, which is 85 cents. That gives us a 17.6% return. So that means with this trade right here, we have a potential of making a 17.6% return on our risk. That is how we determine your profitability with credit spreads. Now let's do the same thing for the $2 wide. So we're going to collect 25 cents and we're going to have a risk of 175. That gives us a 14.3% return. 14.3% return. What are you seeing here? The $1 wide has a higher percentage return than a $2 wide. A $2 wide is at 14.3 and a $1 wide is a 17.6%. And this just happens as you continue extending the width of your spread. So for instance, if we go to a $3 wide, the average return would probably be around 11%. And it would just continuously go down. And that's just how it works in the credit spread world, just with the way that the options are structured. Is the wider your spreads go out, the lower of a potential return you are going to make. And so that is very important for your overall win rate, because that's going to determine what your win rate needs to be. Based on your average return, that determines what your win rate should be, right? So with this, I could have a win rate of around 85%, but with 14% return, I would need a win rate of maybe closer to 90 in order to hit those profitable returns over time. And so again, the difference between the $1 wide and the $2 wide is very simple. Again, the $1 wide is going to have a higher return, but the $2 wide is going to have a bit of a lower return. Now, where the $2 wide has its advantage is this. This is what the $2 wide has over the $1 wide and why I trade the $2 wides. Well, think about it. Let's say my size is getting larger. For instance, I trade a six-figure account. It's a little over $100,000 that I'm trading. If I'm trading a $1 wide spread to get in, I'm going to need to put on 50 to 60 credit spread trades. If I'm paying, let's say, $2 total in commissions for each spread, that means I'm paying $120 in commissions. So let's say at the $1 wide, I need to put on 60 trades, and then at $2 for commission cost, that puts me at around $120 that I'm paying in commissions just to get in and out of this trade. Okay, now how would it work with the $2 wides? Well, with the $2 wides, I'm having the same risk. So instead of putting on 60 trades, I only put on 30 trades. So 30 trades right here times 2, like that, gives me 60. So now I have less of the commission cost. Since I have less commissions, that kind of adds to my overall return. So again, when you factor in the commission cost, roughly $1 and $2 wides are going to be roughly the same, but as you start to size up, $2 wides are actually more favorable. Anyways, if you understand this, if you like this, I hope you did. Smash that thumbs up button and that subscribe button, because I have a lot of videos like this helping you understand credit spreads and helping you become a better credit spreads trader. Anyways, guys, thank you so much for watching. I will see you in the next video.